If you have worked hard, sacrificed, made smart decisions, and built a high net worth, whether that is $3 million, $5 million, or $10 million or more, and you are retired or standing on the threshold of retirement, I need you to stop everything right now and listen to me very carefully. Because the biggest, most dangerous mistake I see high net worth retirees make is believing that the exact same asset allocation strategy that built your wealth is the strategy that will protect your wealth. It is not. You spent 30 or 40 years accumulating assets. You took risks, you reinvested, you rode out market cycles, and you won. But the day you retire, the rules of the game change completely. You shift from accumulation to preservation and distribution. And I know what is sitting in the back of your mind right now. Even with millions in the bank, you have fears. You are asking yourself, what happens if the stock market crashes 30 or 40% in my first 2 years of retirement? What if inflation erodes my purchasing power over a 30-year retirement? Will required minimum distributions push me into the highest tax bracket and destroy my wealth? Am I overpaying some financial advisor 1% every single year just to manage a simple portfolio that I could manage better myself? I hear these exact questions every single day from wealthy retirees who are terrified of losing their financial independence. Here is the truth that Wall Street will never tell you: high net worth asset allocation is not about chasing maximum returns or trying to beat the market index by half a point. It is about creating untouchable security, maximizing tax efficiency, and achieving total sleep at night peace of mind. So how do you structure a high net worth portfolio for retirement? I want you to write down these actionable steps right now. First, you must build what I call the ultimate safety and liquidity bucket. I do not care how rich you are, you never want to be forced to sell stocks during a market downturn just to fund your daily life. I want you to keep 3 to 5 years of your net annual living expenses, the cash you need beyond Social Security or fixed income, in liquid, principal-protected assets. That means high-yield savings accounts, money market funds, and short-term treasury bills. When the stock market drops, you do not panic. You do not touch your equities. You quietly live off your liquid safety bucket and give the market all the time it needs to recover. Second, stop panicking into all bond portfolios. So many people hit age 65, get scared, and dump millions of dollars into fixed income. That is a huge blunder. With modern healthcare, you are going to live until age 90, 95, or even 100. Inflation is a silent thief that will cut the purchasing power of a dollar in half over 20 years. To outpace inflation, you must keep 40 to 50% of your overall portfolio invested in high-quality equities, particularly dividend growth stocks and low-cost index ETFs. Dividend-paying stocks give you an increasing stream of cash flow without having to liquidate your shares, providing both income and long-term capital growth. Third, master your tax location strategy. Taxes are going to be one of your largest expenses in retirement if you are not proactive. Having all your money sitting in traditional tax-deferred IRAs or 401ks is a ticking tax bomb. When your required minimum distributions hit at age 73 or 75, those forced withdrawals can push you into massive tax brackets and trigger higher Medicare surcharges. You must take advantage of your lower income gap years, the years between when you retire and when you start Social Security or RMDs, to execute strategic Roth conversions. Pay the taxes now at lower rates, move that money into a Roth IRA, and let it grow tax-free, withdraw tax-free, and pass to your heirs tax-free. Fourth, remember the golden rule: people first, then money, then things. Your asset allocation strategy is worthless if your legal foundation is not rock solid. You must have a revocable living trust, a pour-over will, a financial power of attorney, and a durable power of attorney for health care. Make sure your trust is designated as the beneficiary where appropriate, and ensure your loved ones know exactly where your assets are and how to manage them if something happens to you. When you protect your liquidity, keep an inflation-beating equity core, optimize your tax brackets with Roth accounts, and secure your estate legal documents, you stop worrying about Wall Street noise. Stand in your power, control your financial destiny, and enjoy the rich, peaceful retirement you have earned.